Hello, everyone, and welcome to another episode of the MRMIA broadcast. I'm your host, Mark LaPrince, and this is the Model Risk Managers International Association broadcast. And today we have another episode continuing our series of interviewing the board members of MRMIA. This time, again, with President Dr. Joseph Breeden, and he will be talking about the work group covering the COVID-19 impact and how it affects model risk management. So, Joe, if you wanted to give yourself a short introduction.
Thank you, Mark. Yes, I'm president of MRMIA and been working on this for about a year now. And in my responsibilities as a board member, I'm leading one of the work groups that we have at MRMIA, focused on how we manage model risk through the COVID-19 crisis and after. So we've got a very talented group of experts from industry who are working on this, putting their best thoughts together so that we can eventually produce a best practices white paper on COVID-19 impacts.
Excellent, excellent. And I know that the COVID-19 pandemic has really just blindsided the entire industry, really the entire world. And as a result, there have been a lot of financial and economic repercussions. We're starting to see data and information like we've never seen before. Things like extremely high unemployment rates, extremely high unemployment claims, and interest rates at its lowest levels in the US and even across the world. So, what has the impact of this kind of data been to models, modelers, banks, and even the model risk divisions? And what should banks be doing about this?
It's an important consideration. When it comes to model risk, the data going into the model is, of course, the first key consideration. And some models broke outright because the rate of change, and rate of change is a common thing to look at, that rate of change has been greater than ever seen before. And so it's natural that the kind of discontinuities you see that in some variables create monthly thousands of percent changes could simply break some models. Then there are issues of data definition. And so if you look at initial unemployment insurance claims, we changed the definition of those who can apply. And so through most of this year, through the crisis period, as much as a third of those applying for unemployment insurance are self-employed, gig workers, folks like that, who never would have qualified before.
Mm-hmm.
So that definitional change in the data means that, how accurate can your model be? Because it's not the same variable you trained on. And then there's a third issue, which is the data quality itself. If you look at, you mentioned unemployment rate, you'll see discussions in articles everywhere that unemployment rate peaked around 14.5%. Well, that's not true. The Bureau of Labor Statistics, who reports the numbers, says that's not actually the case because they acknowledge that their field workers misidentified a lot of the temporarily unemployed. And so BLS says that the real number was more like 19.5%. And the economists were predicting 20%. So you'll see articles that say, well, the economists got it wrong. No, BLS got it wrong. The economists got it right. And BLS knows roughly what the number should be, but their philosophy is that they don't apply statistical adjustments to the raw data. So we get the raw data.
Mm-hmm.
Well, that means our model was trained on data with an assumption of being unbiased through time, but the data we're getting is biased low. Mm-hmm. So that we're telling our models how many people were unemployed, but that's not capturing all of it. So that means the model forecasts are going to be biased. So we've got some real issues here. We've got data volatility, we've got data bias, data definitions, and all of that means that the models are, if they didn't break, and I would say few models actually broke. Most models are telling you what would have happened if not for government assistance and forbearance and all these other things.
Hmm.
But in fact, they're still overestimating, uh, overestimating because of all that assistance.
Right.
Um, and yet, the confidence intervals around these models are really quite large. And any kind of model that takes economic inputs has this sort of problem. Um, and so it's going to cause us to think hard in the future when we're validating a model. And I've seen groups that expect a stress test model in sample to be within 2% accuracy. Well, it's not going to be 2% out of sample. We've seen that this year, that the data wouldn't allow 2% accuracy, period.
Right. Right. So this kind of leaves us with the natural question of what should model risk and what should these financial institutions do about this kind of um, this drastic change in input data that's
Mhm.
breaking models, breaking assumptions, essentially destroying what we use to guide our decisions and make our decisions. What
Mhm.
should they do?
Well, there are two broad categories to think about.
Hmm.
One would be underwriting for new loans. How do we do that in the face of such dramatic impacts?
Hmm.
And the other would be portfolio level impacts. And so for the underwriting question, there's a big difference between those on the books today
Hmm.
who unexpectedly, a large fraction lost their jobs, versus those that when you're doing underwriting, you can do cash flow analysis, confirmed employment, things like that. And this is basically the dichotomy in our economy right now. That's why we talk about a K-shaped economy.
Right.
And so managing your existing book, um, that's going to have a lot to do with understanding the impacts of forbearance and government assistance and all those things. Underwriting, it is these new tools. A lot of organizations that didn't really analyze your cash flows in your checking account, now that's one of the best tools to confirm that your income is not just government assistance
Right.
and that you have continued employment. So it's pushing lenders to use additional tools beyond just a credit score.
Hmm.
And there's a lot of discussion, the credit scores themselves, if it's a bureau score, and a lot of bureau scores are kind of frozen for what they were pre-crisis. Well, that still tells you what kind of consumer you had during good times.
Hmm.
And if somebody was delinquent during the best times, well, they're certainly going to be in trouble now. It doesn't
Right.
get better from there. Um, so those bureau scores, although they're out of date, may still have value, but we have to backfill with some of
Hmm.
these other things like cash flow. So that's a lot of checks, and there's also a pricing question looking forward. And so, how do we think about the risk to those who have jobs today, but the crisis is not over? Will they continue to be employed through next year?
Hmm.
And you don't want to consider those economic factors when pricing the loan for an individual, because we don't want to look at you know local factories and stuff like that. But just in terms of broad categories, you can ask how much risk should you bring into your portfolio with consumers in a certain field, a certain industry. And if you're this is a big question for a credit union that may have a targeted membership. If your membership is teachers, or your membership is, Boeing employees, the ECU is a
Right.
well-known large credit union. These have targeted memberships, so they're going to have different risk profiles, and they're going to have to think that through carefully. Um, on the portfolio overlay side, now you're talking about your portfolio is experiencing the crisis. You don't have an opportunity to filter out. You have to work with your borrowers. Some are fine, some are not. And the irony right now is that with forbearance and government assistance through this year, many lenders are reporting one of the best years they've ever had, because especially consumers who kept their job but received assistance, as many have, um, that puts them in an even better situation. Many who kept their job but aren't going out, aren't going on expensive vacations. Everyone who has money is, or everybody is being more fiscally responsible than ever before. Spending is down. So that's actually depressing delinquency, things like that. But the group who did lose their jobs, now you've got a group that's perhaps in forbearance, depending on your policies. And now you've got to look at what happens from here. So the issue of overlays, simply put, the way we think about it is, your current portfolio forecast model kind of sets an upper bound. What could have happened through this crisis? Now we know it didn't happen. You're somewhere much flatter than that. The volume under that curve is the risk that you have either prevented or delayed. If they get their jobs back, they're going to cure from forbearance. That's the prevention.
Mm-hmm.
If their jobs don't come back, and unfortunately a lot of companies are closing and a lot of temporary unemployed are becoming permanently unemployed, well, then that forbearance becomes just a deferred loss. So some percentage of that goes into additional loss next year. That additional loss next year is going to sit on top of what your stress test models would say would normally happen next year.
Mm-hmm.
So you have to think about, when does forbearance end? When does government assistance end? Because when those things end, my models, which today are dramatically over forecasting, well, they won't be in the future. They're going to form the floor after those things happen. And then we're going to have some overhang on top of that, which is coming from the forbearance from this year.
Right.
So for most portfolios, we expect a peak loss period around, say, Q2 of 2021. So although I think this is going to be much slower to evolve economically than it has epidemiologically.
Mm-hmm.
So we'll have to wait and see.
Yeah, and this is what we're starting to see, kind of not just in the financial industry, but broader as a whole, right? Because regulations are evolving day after day. Um, you have stimulus talks that are negotiations, if you will, that are starting and stopping just about every day now. And it's tough to know what's going to happen next when you're right in the middle of it. So if you can do your best to kind of put on your forecasting lens here, uh, maybe 2 years down the line when the crisis is blown over, what's the aftermath of all this? Are we going to be able to use this COVID-19 data? Is it going to be useful for forecasting our models in the future? What kinds of preventative measures should risk managers take, 2 years down the road to better plan for, address, or prepare for another event like this?
It's an important question, and really, I think much of the work of our committee, our work group, is to think about what comes next.
Mm-hmm.
So we're learning things about overlays, we're learning things about data monitoring and model monitoring, and those will be useful in future crises. But immediately useful in 2021, 2022 will be, what do we do with 2020?
Yeah.
This data, if you want to build a behavior score or an origination score, how do you use this data? Well, you could say maybe a default in your training data set is not the defaults that happened, but the defaults that would have happened. Look
Mm-hmm.
at people who went into forbearance, and at that, some forbearance, we talk about strategic forbearance. They weren't really at risk. It
Right.
was an individual election just to manage their own finances.
Mm-hmm.
Totally get that. They were given an option and they took it. Can we distinguish between strategic forbearance and an actual risk, a real need?
Yeah.
And so those who had need, maybe for purposes of modeling, we call that a default. So when we build our score or build our stress test model, we say, yeah, when unemployment peaks like that, there should have been a wave of losses this year. And so accelerate and enhance some of the losses that will otherwise come in 2021.
Mm-hmm.
That's one option, but there's a lot of data work there. And I guarantee there'll be a lot of skepticism from auditors and examiners saying, wait a minute, you just made up a lot of data. How do you know that's right? So it'll be tough, but it may be the right answer, but it'll be tough. We know that. From a portfolio perspective, especially stress testing, same issue, just as hard, that, you know, do we include that kind of data when we're building a stress test model where we see the worst crisis in
Mm-hmm.
any of our data sets having no losses? Well, if you integrate over a long enough period of time, of course that works, but stress test models are generally point in time instead of
Right.
integrated. So we're either going to have to skip 2020, which is a shame because it's a real event, but we've got so many data integrity problems, you know, the inputs and the outputs. What rate are people going to use for unemployment in the future? If you go to Fred, if you go to any of your favorite data vendors, they're going to report 14.5%, even though BLS said that number is wrong. Will you be allowed to record an estimate of the right number in your training data for unemployment rate? That may again be a tough one to get past the auditors, but it would not be an invalid approach.
Mm-hmm.
So something to think about. I'd say the third category is with economic capital and volatility analysis, because an economic capital model is all about the tail. I mean, stress testing,
Yeah.
we usually think about economic stress and we see the problem already. But economic capital is usually about a distribution for a year or some period of time. And in that distribution, what is the tail like? And pandemics are supposed to be part of that distribution. That's why we talked about the Hong Kong SARS recession. That was a
Mm-hmm.
pandemic data point. And in 04, 05, you know, before the 2009 recession, the Hong Kong SARS recession and pandemics were top of mind in a lot of organizations. And then the mortgage crisis came and people forgot about pandemic stress testing for a while. Um, so this data, if we look at it a little differently, we could say, you know, in a time of severe crisis, there will be countermeasures.
Mm-hmm.
If anything, in 2009, in that recession, there were countermeasures. They extended the period of unemployment benefits out to 99 weeks.
Yep.
There were a lot of things that went on. Nothing as severe as what we've done today, but I think what this proves is that the more severe the event, the greater the countermeasures. But if you look integrate over a long enough period of time, in this case, maybe you need a couple of years, you'll see there are impacts.
Mm-hmm.
And so there may be a way to look at this data and say, there's nothing here to adjust. This is reality, and this is not a bad, well, I'm not going to claim we managed this very well, but let's just say in a severe event, we can expect, financially speaking, a large response, and that can happen again in the future.
Right.
Now, one thing related to this, before I hand it back to you, all of that was about model development.
Mm-hmm.
What about model validation? You know, the model risk management aspects really focus on validation. I'm afraid that if I build a model next year, somebody's going to say, hey, I need to see a back test of this model. Show me how it worked last year. Like, no, I do not want to show you how my model would have worked in 2020. That's going to be a real problem. We're going to have to get some consensus about how we think about this data when it comes to validation. If we skip over it for model development, then I think we necessarily have to skip over it for validation as well, because it's just crazy.
Mm-hmm.
We may have to look to validate in 2021. So
Right.
these are policy questions where we want to put out some ideas, but we're going to have to get agreement from regulators and auditors that they'll accept these proposals. So we'll see how it goes.
Yeah, it is. It is an evolving field, and I'm really glad to hear some of your thoughts on uh, the responses and the potential outcomes that can happen from this, and the downstream consequences that it might hold for developers and the model risk folks in our community. So, Joe, I wanted to thank you again for joining us again today. And to our viewers, I hope you guys can tune in next time.